Thank you, Mr. Chairman. I won't take a full 10 minutes, and I'd like to say that we'll be submitting additional answers to your questions very shortly. Chairman Angelides, Vice Chairman Thomas, and other members of the Commission, your charge to examine the causes of the recent financial and economic crisis are indeed important. Only by understanding the factors that led to and amplified the crisis can we hope to guard against a repetition. So-called too-big-to-fail financial institutions were both a source, though by no means the only source, of the crisis, and among the primary impediments to policymakers' efforts to contain it. In my view, the too-big-to-fail issue can only be understood in the broader context of the financial crisis itself. In my full written testimony, I provide an overview of the factors underlying the crisis, as well as some of the problems that complicated public officials' management of the crisis. In understanding the causes of the crisis, it's essential to distinguish between triggers, the particular events or factors that touched off the crisis, and vulnerabilities, the structural weaknesses in the financial system and in regulation and supervision that propagated and greatly amplified the initial shocks. Although a number of developments helped to trigger the crisis, the most prominent was the prospect of significant losses on subprime mortgage loans that became apparent shortly after house prices began to decline. While potential subprime losses were large in absolute terms, judged in relation to global financial markets, they were not large enough to account for the magnitude of the crisis on their own. Instead, the system's pre-existing vulnerabilities, together with gaps in the government's crisis response toolkit, are the primary explanation of why the crisis had such devastating effects on the global financial system and the broader economy. Let me give an illustration of how vulnerabilities in the financial system greatly increase the effects of the triggers of the crisis. In the years before the crisis, a system of so-called shadow banks, financial entities other than regulated depository institutions, had come to play a major role in global finance. As it grew, the shadow banking system, including certain types of special purpose vehicles such as those financed by asset-backed commercial paper and some investment banks, had become dependent on short-term wholesale funding. Such reliance on short-term uninsured funds made shadow banks subject to runs, much like commercial banks had been prior to the creation of deposit insurance. When problems in the subprime mortgage market and other credit markets became known, the providers of short-term funding ran from the shadow banks, disrupting short-term money markets. Thus, the vulnerability, in this case the excessive dependence of many financial institutions on unstable short-term funding, greatly amplified the effects of the trigger, in this case the prospective losses on subprime mortgages. Among the consequences of this instability were sharp declines in high volatility in asset prices, widespread hoarding of liquidity by financial institutions, and associated reductions in the availability of credit to support economic activity. Many of the key vulnerabilities of the financial system were the product of private sector arrangements, including, as just noted, overdependence of many financial institutions on unstable short-term funding, poor risk management, excessive leverage of some households and firms, misuse of certain types of derivative instruments, mismanagement of the mortgage securitization process, and other problems. But important vulnerabilities also existed in the public sector, both in the United States and in other countries. These vulnerabilities included both gaps in the statutory framework and flaws in the performance of regulators and supervisors. Important examples of statutory gaps were the absence of effective authority to regulate and supervise some important types of shadow banks, such as special purpose vehicles and broker-dealer holding companies, the lack of authority or responsibility to take actions to limit systemic risks, and the absence of a legal framework under which failing, systemically critical non-bank financial firms could be resolved in an orderly way. Where appropriate authorities existed, financial regulators and supervisors, both in the United States and abroad, did not always use them effectively. For example, bank supervisors in many cases did not do enough to force financial institutions to strengthen their internal risk management systems and to curtail risky practices, and bank capital and liquidity standards were insufficiently stringent. The recent financial reform legislation addresses many of the statutory gaps I have mentioned, and the Federal Reserve and other agencies are taking strong steps to tighten the regulation of financial institutions, to give regulation and supervision a more systemic and multidisciplinary orientation, and to make supervision more effective. Many of the vulnerabilities underlying the crisis were linked to the existence of so-called too-big-to-fail firms, those whose size, complexity, interconnectedness, and critical functions were such that their unexpected failure was likely to severely damage the financial system and the economy. Because of the grave risks presented should a too-big-to-fail firm file for bankruptcy protection, in the short run, governments have strong incentives to prevent such events from occurring, hence too big to fail. However, in the longer term, the existence of too-big-to-fail firms creates severe moral hazard problems, which can lead to the buildup of risk and future financial instability, while complicating the resolution of financial crises. The existence of such firms also creates an uneven playing field between the largest firms and their smaller competitors. It is critical that the too-big-to-fail problem be solved. An important component of the solution contained in the recent financial reform bill is the development of a resolution framework that allows the government to resolve a failing, systemically important, non-bank financial firm in an orderly way, while imposing appropriate losses on creditors, protecting taxpayers, and limiting risks to the broader financial system. Tougher regulation and supervision of systemically important firms and steps to increase the resilience of the financial system are also important if we are to bring a decisive end to too big to fail. The findings of this commission will help us better understand the causes of the crisis, which in turn should increase our ability to avoid future crises and to mitigate the effects of crises that should occur. We should not imagine, though, that it is possible to prevent all crises. A growing, dynamic economy requires a financial system that effectively allocates credit to households and businesses. The provision of credit inevitably involves risk-taking. To achieve both sustained growth and stability, we must provide a framework which promotes the appropriate mix of prudence, risk-taking, and innovation in our financial system. Thank you, Mr. Chairman.